Welcome to Dalal Street. It's the epicenter of Indian finance, built on the promise of fast, life-changing wealth. It is also an arena where 90% of all active traders eventually lose their money. It's here that the naive protagonist of Santosh Nair's Bulls, Bears, and Other Beasts steps onto the trading floor, arriving at the exact moment a massive economic boom begins. In a true bull market, widespread economic optimism creates a wave of aggressive buying. Stock prices surge across the board. The sheer momentum is so strong that even fundamentally flawed, failing companies see their valuations jump. This creates a highly effective psychological trap. When the entire market is trending up, it's remarkably easy for a novice trader to look at their growing portfolio and confuse a favorable economic climate with their own personal genius. Riding a streak of these effortless early wins, our trader stops reading balance sheets entirely. Deep research is replaced by chasing rumors and hot tips. This chart illustrates what happens next. The lower, steady line represents the trader's actual cash. But feeling invincible, they start using leverage, borrowing money from their broker to multiply their bets, which creates this steeply accelerating top line. Look at the growing gap between those two paths. That empty space is a mathematical vacuum. The trader is now making massive bets with money they did not actually possess, leaving them completely exposed. Without realizing it, they've crossed the line from investing into high-stakes gambling, riding an unchecked wave of arrogance right toward a cliff. Then the cycle turns. A bear market triggers when liquidity suddenly dries up. The buyers who drove prices up vanish, and with no one left to purchase shares, valuations begin to freefall. You can see the exact moment the panic sets in on this ticker. As the BSC Sensex flashes deep in the red, traders realize the momentum has broken, setting off a desperate, market-wide rush to sell. Looking back at our portfolio chart, the trap snaps shut. This is a margin call. Brokers demand immediate repayment of borrowed funds. To cover the debt, the trader liquidates plummeting assets, causing the leverage line to violently collapse and wipe out their capital entirely. The entire portfolio is vaporized. The early unearned wins are erased, replaced by catastrophic financial ruin in a matter of days. But the economic downturn alone didn't bankrupt our trader. The collapse was actively accelerated by the market's hidden ecosystem. These are the other beasts of Dalal Street. Beyond the natural cycles of bulls and bears, the market is filled with institutional manipulators and algorithmic traps designed specifically to trigger and exploit the blind panic of amateur retail traders. The final nail in the coffin is psychology. Gripped by paralyzing fear, the novice freezes. Instead of cutting losses early, they hold on to their bleeding positions, hoping for a miracle recovery. The stock market functions as a highly efficient processor. It systematically drains wealth from the emotionally reactive, handing it directly to the mathematically disciplined. Rather than walking away defeated, our protagonist sits down to dissect the wreckage. They strip away the ego and the emotion, building a new mechanical framework for survival. This chart demonstrates the stop-loss order. A plummeting trade hits a rigid, automated floor, instantly stopping the descent. Looking over time, the goal is to cap the downside, so bad trades remain superficial paper cuts, easily absorbed by the upward trend of winning bets. By defining exactly how much they are willing to lose before a trade even begins, the trader neutralizes their own fear. They are no longer vulnerable to the panic cycles that wipe them out. When our trader returns to Dalal Street, they look very different from the anxious crowd in this image, staring up at the index screens. They have completely detached from the herd mentality, replacing it with cold, mechanical execution. The comeback is a grueling process. There are no sudden windfalls, just the methodical grind of deep research, strict position sizing, and unrelenting discipline. They still take losses regularly, but those losses are now expected, calculated expenses, built directly into the cost of doing business. The ultimate lesson of the market is written right there in the ledger. Building lasting wealth doesn't require you to be a flawless genius who never makes a mistake. It requires you to design a system that survives catastrophic failure, keeping you in the game just long enough to win.